Good morning. It's Vijay here. Today is Tuesday, 20th of August 2024. Welcome to yet another episode of Pre Market Commentary. Yesterday, I was expecting things would be quite good in the Indian markets, and it was like what we call a curate's egg, good in parts. The broader market did extraordinarily well. The micro cap and the mid cap, excuse me, yeah, sorry, the fan was creating some noise. Anyway, the broader market did extraordinarily well while the mainline indices struggled. Nifty struggled through the day and it closed only at 31 points higher. In fact, the opening was the high, which is generally not a good sign. Bank Nifty closed in the red, and the other indices did very well. The Nifty came down primarily because of private sector banks, autos. Whereas in case of Bank Nifty, of course, the private sector banks were the culprits, while the public sector banks tried to hold the line. Now, globally, the things are getting better, but there are worrywarts, as I call them, the old bandicoots who keep on worrying. What will happen in Bangladesh? What will happen in Pakistan? What about Iran attacking Israel? What about Israel retaliating and the World War III will start? What happened to Ukraine going into Russia? What about the conventions, Democratic and Republican conventions? What is going to happen there? And so on and so forth. What about Fed? What about oil? What about N? I mean, you've got number of things to worry, but the markets are showing us the path. The path is clear for the markets, may not be clear in our minds. The markets are saying, why worry when, things are, and why worry when I'm here, kind of thing. So just look at what global markets are doing. US market specifically crashed as soon as that N strengthened, but now all of them have recovered significantly, and they have come to about 1% below an all-time high. So yesterday was a tremendous day with Dow Jones going up 235 points, S&P 55 points, and Nasdaq about 250 points. That has been reflected here in India. That has been reflected here in Asia, with all the Asian markets barring Hong Kong, which is the sick man of Asia, I would say, as far as stock markets are concerned. They've all gone up. Yesterday, Nikkei had lost, and Nikkei has regained everything as of now. We speak, it's about 625 points. Hang Seng is down by 55, whereas Singapore is up by about 22 points, and Kospi up by about 25 points. And European markets also did very well. We were quite, excited when FIs bought on Friday. We thought they will continue, but yesterday they have gone back to their old ways of selling on every rise. Now, if you look at FI data, it's very, very interesting. FI's ownership of Indian equity, listed Indian equity, is at a 12-year low. So the last time we saw this was in December 2012, when we were in the midst of a recession, and nothing was working for India. And subsequently, FIs bought in at one point of time. They were 17% and odd in terms of the percentage holding in listed equity. And now they have come down below. Now they have come down below 16, somewhere 16 to 17%. So what has happened is, in the last few years, FIs have been generally net sellers. But the markets, if you look at what they were in 2012, they would have been around 7,000. And today in Nifty, we are talking about somewhere at close to not even 7,000. I think it was 6,000 and odd. Now we are 4 times more than what it was 12 years ago. So what's changed? The domestic institutions, the retail investor, the government of India, all of them have put in money and made Indian market what it is. This is not to say that there are no worries around. I have been mentioning the number of worries, both on fundamental and politics and whatnot. But when global central banks begin to ease their rates, that is, bring in liquidity, every single time the markets have gone up. I mentioned that in the study. I'm repeating it again. 1987, I'm talking of Fed, 1987, 1998, 2001, 2007, 2018, and 2020. So all these times, the markets took off as soon as the Fed started the rate cut. Of course, in 2007, they were already under a recession, so they didn't go up too much, but they still went up for 3 weeks. Today is the first time in the last 40 years I am noticing that the Fed is reducing rates or in the process of going to reduce rates when the markets are at all-time or near all-time highs. This is the first time. So I expect, yesterday I mentioned, over the weekend I mentioned that we'll probably have a parabolic rise, because never has it happened in the last 40 years when Fed has begun an easing cycle and the markets are at these levels. Every time Fed has come to the rescue of the markets. Today, it is not so. Markets are independent of the Fed's actions, and they're only going to add, momentum, the reduction of rates. India also will reduce, as I keep mentioning. Now, so therefore, FII selling should not be of much concern to us, though it could be a worry for the very short term. For a day, yesterday, for instance, was very tough to trade on the long side because the FIIs were selling. Now, sooner or later, the balance will change. We are already close to the balance where the tipping point where we will own, the domestic will own more than FIIs, domestic institutions I'm talking about, apart from the retails. So therefore, I think there is no need to worry. If they have to worry, it will show in the prices. And the prices just now are saying that they want to go up rather than go down. So I would be very, bullish. Buying on declines, no need to get overexcited. Number of opportunities are there, especially the Bank Nifty. I think the Bank Nifty is a sleeping lion. Bank Nifty's P ratio is the lowest in many, many years. And therefore, I think the place will be Bank Nifty. Right now, Bank Nifty is looking very bad as far as the prices are concerned. But in my opinion, Bank Nifty should lead the parabola. So whatever you do today, I hope you have a profitable day. Thank you for joining me. Have a good day. It's Vijay here, signing off.